Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Hello, Michael.
Very good afternoon to you, mate, from an incredibly warm city of London.
Yeah, it's actually fairly warm down here in Croydon as well. Actually,
It's not that far away.
hence the fact that I actually have I've rolled my sleeves up today.
You're going to tell me you're in shorts under there as well next.
No, sadly not, mate. No one wants to see those knees. Anyway,
Agreed.
Indeed. So anyway, more records this week for the stock markets. FTSE 100 joining the party as it closes in on 9,000, which is quite timely given our conversation last week.
Yes, absolutely.
While the DAX has continued its recent run as well. So US markets, I think, sort of treading water this week.
A little bit.
What's been the key driver, I think, this week? Because obviously they've thrown off the 50% tariff on copper and pretty much ignored that.
Yeah, I mean, it's been a bit of a weird week, to be completely honest with you. Say markets just sort of grinding steadily and slowly higher, and the market really just shrugging off any risk around tariffs. And speaking of risk,
that's a great segue, Michael.
Not my first rodeo, mate.
Exactly. So here we go. The risk warning goes right ahead. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So obviously the topics this week, we're going to talk about what's driving markets. The July the 9th deadline has been and gone. Now it's the 1st of August. Record highs for the FTSE 100 and the DAX this week. Markets increasingly ignoring the tariff trade battle. TACO again. Trump always chickens out. 50% copper tariff, so we'll talk about that. Talk about silver. It looks as if it could well continue to drag the miners higher. Nvidia, $4 trillion market cap. We'll talk about the drivers behind that. Central banks, we'll talk about that. RBA and RBNZ surprisingly held rates this week, so that's a bit of a surprise. Yeah. So we'll talk about that and the Fed minutes. We'll talk about obviously the focus on Jackson Hole now because that shifts. More M&A this week. Merck buying UK-based Verona Pharmaceuticals for $10 billion. And then we'll talk about 1 week on from Rachel's tears. Bank of England warning about borrowing. Shots fired there. And look at this week's earnings. The week ahead, US bank earnings, Netflix, UK inflation and unemployment. So, where should we start, matey?
Well, I suppose we may as well start with tariffs because
tariffs, yeah, absolutely.
You know, I think the interesting, probably the question I've been asked most by clients and journos alike this week is, you know, we are potentially on the 1st of August going to be at tariff levels that were pretty much where we were on Liberation Day on the 2nd of April. Yet back then the market was trading down at 4,800 if you look at the S&P, and everyone was screaming about recession, and this time round it's almost as if nothing happens, which or is going to happen, which says to me that markets, probably rightly, aren't really taking this as a serious threat and are viewing this much more as a sort of negotiating gambit.
I mean, I think the reaction of the miners is interesting because we talked about this a little bit last week. Obviously, they've been amongst the worst performers so far year to date. Over concerns about tariffs, and yet Trump comes out this week and says he's going to put a 50% tariff on imported copper into the US. Miners go up along with copper prices. So, yeah, what's all that about?
Well, although you say copper prices have gone up, they have, but there has been quite an interesting divergence between copper that's traded in Chicago and copper that's traded here in London, because copper prices in the US have, I think they're trading at a record, something like a 28% premium over copper that's traded on the LME. So there's clearly this rush because copper tariffs aren't due to go into play until the 1st of August as well. There's clearly this massive rush to get copper into the US before they are subject to those tariffs, which, it must be said, were considerably more severe and loftier than I think markets have been expecting.
Mm. I mean, and on top of obviously steel and aluminium, not aluminum, aluminium.
You get it right.
Yeah, exactly. Um, you know, miners have underperformed. Does this mean that we could well see the miners start I'm looking at my charts today, or my price charts today, and the miners having a good day today. And obviously the
Hmm.
FTSE 100 is closing in on 9,000. And we did sort of indicate that if mining stocks suddenly came back into vogue, that might help propel the FTSE 100. And here we are a week on, and look where we are, 89.75, the high so far.
Yeah, and all credit to you. Your 9,000 call from the back end of last year looks like it could be finally coming to fruition.
Well, I'm 25 points away. I'm considering it done, mate.
Nothing like a little bit of creative accounting on a Thursday afternoon.
Well, politicians do it all the time. Why can't I?
Oh, well, can we save that discussion for a bit later on?
Yeah, all right, let's do that. Let's do that. I think Nvidia, I mean, wow, $4 trillion. First time that a company has been valued and larger than the German stock market combined. I think I heard that bandied about earlier.
Crazy.
I mean, it's absolutely crazy. Taiwan semiconductor revenues, I think, was the catalyst this morning.
Yes.
That helped drive that higher. How much higher can we go?
It doesn't seem like there's any stopping it at this moment in time, to be completely honest. I did steal this statistic from the BBC, so I'll give them a little bit of credit for something, rarely. But 8 years ago, Nvidia were trading at less than 1% of their current share price, which just shows you how meteoric this rise in value has been. And obviously the AI craze over the last sort of 4 or 5 years has been the main driver behind this. But I mean, frankly, Nvidia are the sort of ultimate picks and shovels play of the whole AI capex explosion. And there really doesn't seem to be any sign of them slowing down anytime soon, to be completely honest with you. All the time that companies around the world are investing more and more into AI, the greater the demand for Nvidia chips is going to be. The only question is that age-old one that we keep asking, and I'm sure we'll end up asking again at the back end of August when we come around to their earnings, which is, are Nvidia going to be able to keep up with the demand? Because there's no problem with demand. The only constraint is going to be in terms of supply, potentially.
Yeah, I mean, looking at TSMC revenues, 39% up on the quarter, sales $32 billion. That's just in one quarter. Its biggest clients are Nvidia and Apple. And it's the AI. It's the AI boom, isn't it? It's what's driving this boost in revenue. And ultimately, I think not only is it, I think, a case of capacity for Nvidia, I think it's the case for capacity constraints with respect to TSMC as well.
Yeah, no, you're absolutely right. And of course, the other one to consider in that mix is ASML, who of course make all of the various machines that are used to make the chips. If you want to go sort of right back to the start of the value chain, but yeah, setting that aside, fundamentally, I think the bull case for those three is very, very strong indeed.
Yeah, which sort of brings me to the Trump factor in this, because ultimately with ASML, you can't replicate that in the US.
No, and
So
I
what?
do. Oh, go on.
So what does he do?
Well, this is the $64,000 question, I suppose. What does he do on that front? I mean, TSMC, there was news towards the back end of last week that they are now sort of reallocating some of their investments. I think they're going to prioritize the construction of a factory in the US over a second one in Japan. As you say, can ASML do the same? Will they want to do the same? I wonder whether that's something that might end up coming out in the wash of any potential EU-US trade deal, even when that is indeed agreed.
Yeah, I think that's something that potentially, could undermine the current, I think, bull case for tech. And I would argue it's probably the $4 trillion question.
Oh, very good, very good.
Yeah. Anyway, let's move on, because obviously risk is fairly buoyant now. There doesn't appear to be anything that is going to deter these markets from pushing higher. Certainly the bond markets appear to have settled down. And surprisingly, the RBA held rates this week, as did the RBNZ. We were expecting the RBNZ to hold, but I don't think a lot of people were expecting the RBA to hold. So what's going on there?
No, the RBA decision was a little bit of a surprise, and actually, I think the commentary that we've had from the RBA in the aftermath of that decision has been a bit surprising as well. The RBA governor was effectively saying, it's not our job to guide markets. Markets were pricing a 90% chance that they would deliver a 25 basis point cut on Tuesday morning. The RBA governor saying, we're not going to massage expectations. We're going to do what we think is right in terms of policy. And the without getting into the weeds too much of Australian macroeconomics, the way things work down there is a little bit odd. So we have inflation numbers once a month here in the UK, CPI every month, very regular. We in fact have the latest inflation numbers next week, which we'll discuss later.
Yeah.
In Australia, things are a bit different because they only have those CPI numbers quarterly, and then they produce a monthly estimate of inflation. The problem is with that monthly estimate, the basket of goods that they use changes depending on where you are in the quarter. So early in the quarter, the basket is heavily tilted towards goods, and then later in the quarter, it's much more heavily tilted towards services. So it's actually really hard to get an idea of where inflation is. So what the RBA have effectively said is we're going to sit on our hands this time out. Our next meeting is in the middle of August. We will have the Q2 CPI numbers by then. They just want a little bit more confidence that inflation is moving in the right direction before delivering that rate cut. So, yeah, it was a hawkish surprise, but it's a case of sort of cuts postponed rather than cuts scrapped entirely.
Okay. Which sort of brings us on to the Fed minutes. Showed little in the way of support for a cut in rates at the recent meeting, but I was struck by this line with only a couple of members indicating that a cut in July might be reasonable.
Well, we know
I wonder who those might be.
Well, that's quite obviously Mickey Bowman and Chris Waller, the two Fed governors who have actually said that in public remarks since the meetings. Of course, the minutes are sort of 3 weeks old. I think what will be interesting, and we mentioned this last week, of course, is whether they actually vote for that July rate cut, because, of course, we had the pretty solid jobs report out of the States this time last week. We have US inflation due on Tuesday, but assuming that we start to see a little bit of tariff-induced price pressures there and the labour market remains resilient, everyone else on the FOMC is saying, we'll wait and see. We're happy to just see how the economy evolves and deliver a rate cut in due course once we have greater certainty. The question is, do those two actually vote for, put their money where their mouth is effectively, that politically motivated rate reduction?
That'll be very interesting. When is the Fed meeting?
31st of July, so we've got a little bit of time to wait.
Okay. Well, in that case, the next focus, I can't see them doing anything in July, even if Bowman and Waller vote for a cut.
No, rates will be unchanged.
Yeah, I think it'll be unchanged. So it's really about Jackson Hole, the end of August, for a possible September move, if we get one at all. Certainly, I think the markets. But again, we've got US CPI next week, so again, that could muddy the waters further. So,
yeah.
But yeah, you're right. I think what they do in July could be very interesting, given recent continued comments from the US president.
Well, he's of course now saying that they should lower the Fed funds rate by 300 basis points. Last week it was 250 basis points. I think this week, next week, it'll be calling for negative rates. But mercifully, those calls are falling on deaf ears.
Yeah, I would call that Fed rate cut inflation.
Yeah, it does seem to be going that way. You know what? I did actually see, I can't remember who this was, so I'm going to cite this uncredited, but forgive me for that. But someone was saying that, Trump's view of interest rates is potentially clouded by his history in real estate, where all that matters is credit quality. So effectively, the biggest building, the best buildings in the world, they borrow against those at the lower interest rates. And Trump is using that same view on a sovereign basis where, sadly, not quite as simple as that, where he's going, we're the best economy in the world, we should have the lowest rates. A lot more in the mix, unfortunately.
Yeah, I don't think we really need to be taking lessons from someone in real estate who's been made bankrupt 4 times.
I thought it was 5.
Is it? Well, whatever.
Yeah. Point stands.
But the point still stands, doesn't it? Yeah. Okay, so we've had more M&A this week. Merck buying UK-based Verona Pharmaceuticals. That Verona is listed in the US, mind you. So
yeah, we can't add that to our list of Exodus.
But I think what that means is that there are still bargains out there when it comes to M&A. And this morning we've had Ferrero buy WK Kellogg for I think $3.1 billion as well. So there are pockets of value there for, I think, acquisitions and what have you. But I think when you look at the UK pharmaceutical industry, going back to the Verona deal, um, that's given the pharma sector a little bit of a lift as well, with a renewed focus there. Because you look at companies like Astra, GSK, Haleon, all based here on the FTSE 100. Maybe there's some potential value there, which could help drive the FTSE higher still. And they did underperform in the first half of this year.
Yeah, exactly. And of course, we touched on AstraZeneca last week, who are still thankfully here. They haven't
Yeah.
abandoned us just quite yet. And them and GSK are absolute index heavyweights there. So if we do start to see a renewed focus and potentially outperformance in the sector, then that could be a bit of a boon for the headline index.
Yeah, indeed. Okay, the Bank of England met this week. Well, they
Yeah,
didn't meet
their
this week. It was the
financial
financial
stability
stability.
report. Yeah.
And shots fired over borrowing.
Yes. Well, also, of course, we heard from the OBR this week as well, didn't we?
Richard Hughes. Yeah, he had some very interesting things to say about budgetary responsibility and the fact that it couldn't go on the way that it is.
Yeah. That was really the nub of what he was saying. I think the number they threw out, the OBR was that debt GDP could be somewhere about 200-250% by the 2070s if we carry on this current path. I mean, I think the actual estimate in terms of the point estimate is immaterial. The big issue is once you get above 100 on a sustained basis, then it's really easy for things to just balloon out of control. I mean, all you need to do is look at Japan for your evidence of that one. I mean, this doesn't really tell us anything new, but I think it is interesting. Everyone who follows UK markets knows that the fiscal trajectory is unsustainable, but I think it is interesting that we're hearing this now in much more explicit terms from institutions who would typically, maybe not when Mark Carney was running the show, but typically try to be as impartial as possible. And certainly even more issues for Rachel Reeves to deal with in the run up to the autumn budget, which is probably 3 months away or so.
Yeah, but I think this was done, particularly from the Bank of England's Financial Policy Committee, was done on the grounds of financial stability and the bond markets.
Yeah.
And obviously the effects that what's happening on the other side of the Atlantic, if you get a spike in US yields, that will ripple across the Atlantic to over here. And at the moment, we're not seeing any significant moves in UK gilt yields. But that doesn't mean that if US yields spike, that we won't get similar spikes higher here in the UK.
Yeah, absolutely. And of course, the other thing to consider, and Andrew Bailey was talking about this last week, at the press conference on Tuesday, is the BOE's role in all of this. Because not only do they have a financial stability purpose, they've got a monetary policy purpose, of course, as well. And one of the things that they are doing on the monetary policy side is continuing with these active gilt sales. Now, that decision is up for review in
They need
September.
to stop that. They need to stop that.
I think they're going to have to. I mean, I think it's at the point where it's just silly. Frankly, well, I understand the initial rationale around let's get the balance sheet lower as quickly as we can while the market can absorb it. The issue is I think we've now proved that there's really no need to do it, and all you're doing is creating more and more losses that the Treasury have to indemnify you against. And actually, that's the point I wanted to come on to, because how the OBR model that, I think, is going to be key for Rachel Reeves, because that could have a significant impact on the degree of fiscal headroom she does or doesn't have, and by extension have a significant impact on the tax rises and or spending cuts that she therefore needs to introduce. Because if the OBR suddenly model none or a much slower pace of active gilt sales, that's a much lower loss that the BOE are going to incur, which gives the Treasury more sort of wriggle room from a fiscal perspective. So I think that's certainly one to watch as we move towards the September MPC meeting, which is, of course, a couple of months away still.
Yeah, I mean, spending cuts, I've got a bridge to sell you if they happen.
You and me both.
It's going to be tax rises. Unfortunately, I think we're beyond the point now where tax rises are revenue positive. They're not. They're revenue negative, and we're already seeing the effects of that. I think in some of the numbers that are coming out. The harder you squeeze the sponge, the less water you get out of it. And I think we're at that stage now, if I can use that particular metaphor.
No, I think you're absolutely spot on. I mean, the classic example is, of course, the Laffer curve.
Yeah.
You get to a point where tax rises are actually counterproductive, and they
Mm,
are not raising increased revenues. And
mm,
I think we're seeing that in, like, there was a stat doing the rounds the other day. It was actually our good friend Dick Matthews told me on
mm,
yesterday evening that apparently London has seen the biggest exodus of millionaires of anywhere in the world, apart from Moscow,
mm,
over the last 12 months. Now, I think the exodus from Moscow is perhaps slightly understandable.
yeah.
If you exclude them from the statistics, then we're just shrinking our own tax base, which is
Yeah.
never going to end well. Let's be honest.
Well, it's going to hit the middle classes the hardest.
Absolutely. And I know Labour pledged in the manifesto, and they said again this week at PMQs, we're not going to raise income tax, we're not going to
Mm.
raise VAT. At some point, I think
They're
they're going
going
to
to have
have
to.
no choice but to
Mm,
pull one of those big revenue raising levers. And from a political perspective, if you're Keir Starmer, you're still 4 years out from an election. It's going to be an unpopular decision. You've got an unpopular chancellor who you can sacrifice to get that through. It looks increasingly politically expedient to just bite the bullet on that one, as much as I'm not an advocate of that sort of a policy.
yeah, but I mean, once they do that, they're pretty much cooked. Once
Oh, I
Reeves
agree.
goes, the bond markets will just say, "All right, you're done.
Yeah,
You're done. We have no more. We have no further faith
yeah,
in your ability as a government to manage the public finances."
yeah.
And you will see. I predict you will see a significant sell-off
Mm.
in some parts of the gilt curve.
Yeah, I mean, I was reminded this morning of the famous Bill Gross quote about the gilt market being on a bed of nitroglycerin. I mean, I think we need something stronger than
Mm,
nitroglycerin to sum up where we stand at the moment, because it is, frankly, a very fragile situation, incredibly
mm.
dicey situation. And the more I think about it, the more I struggle to find a happy ending to it all.
Oh, indeed. Okay, well, let's move on. This week, let's look at this week's earnings numbers.
Hmm.
It wasn't originally on my list, but we talked about it last week. WPP, worst performer on the FTSE 100, publishing company, declines in revenue. The shares fell to a 16-year low after reporting another set of disappointing numbers, H1 numbers, and they issued a profits warning.
Hmm.
They have announced a new CEO this morning, Cindy Rose. Um, but ultimately, they've dropped below that 450 level that I think I was talking about last week. It's going to take an awful lot to steady that particular ship.
Well, it feels like a sinking ship is actually the analogy
Mm,
that I've written down here, to be completely
mm,
honest with you. We discussed, how pessimistic the outlook for the sector
mm.
appears, last week in the podcast. And frankly, I would not want to be in that new CEO's shoes. I mean, you
No.
you really are, that it really is a thankless task. I mean, there's nothing to like in those earnings
Mm,
whatsoever. And you're dealing with a declining company in a declining sector.
mm.
Yeah, I mean, if she manages to turn it around, great.
Well,
But I
yeah,
certainly don't see much value in it right now.
yeah, fair play to her if she does, because ultimately, for me, it's akin to basically being appointed the captain of the Titanic after it's hit the iceberg.
Yeah, I think you're probably about right on that one. And yeah, Mark Reeves probably getting out at the right time.
Yeah, probably would. Yeah, absolutely. So, yeah, I mean, for me, I think if that for that ship to steady, we need to get back above those for that 450 level because we're trading below that at the moment, around about 435,
Yeah,
440.
what are we down to now? Mid-teen percentage points, I think it was, wasn't
Yeah,
it?
let me just have a quick
Sorry,
look.
I appreciate I've rather sprung that on you, but I
No,
think
you
they
haven't.
opened down about 15% or so. And
They're up 1% today, but they were down 15% yesterday.
there you
So
go.
so they're rebounding a little bit, but it doesn't look particularly
I
good.
think that's a bounce of the dead cat variety, I think, more than
Yeah.
anything.
Airlines in the news today
Oh
and
no, here we
obviously
go.
yesterday. We had Delta this morning
Yes.
reinstated their full year guidance because they
Mm.
said that the picture is cleared, the fog has cleared, and the runway is clear in terms of the outlook.
Oh dear. Oh dear. Yes, they did. And actually, Delta shares is trading about 11% higher today.
Yeah,
They've taken off
they've taken
since
off.
the market
Mm,
opened. And yeah, I wonder whether this is going to become a more sort of common theme among some of the other airlines in the
mm,
US. We've still
mm.
obviously got American and
Yeah,
United yet to report. And I think all of them became not necessarily pessimistic, but very cautious. Of course, you've got to recall that they were reporting earnings mere weeks after Liberation Day for Q1.
Yeah.
So it was natural for those firms to say, we're not going to issue any guidance, or we're going to issue very cautious guidance. I think United actually issued two scenarios in their guidance, if I remember rightly. But clearly, conditions have evolved better than they expected, and you're seeing some upgrades as a result of that. So yeah, things are starting to look a little less turbulent.
Absolutely. Though having said that, here in the UK, Jet2 shares lost a bit of altitude, hit a bit of an air pocket yesterday, despite the fact that they showed a 15% increase in revenue, which is pretty impressive, and profits after tax rose 12%. So I'm struggling to understand why that happened.
Well, I think that was probably a guidance thing more than anything else, as you've handily written in your notes here. They kept their guidance unchanged, which I think is one of the reasons why the market has perhaps taken a slightly dimmer view of things than the figures themselves would imply is just. But yeah, I think that speaks to the sort of general reaction function when it comes to earnings. Participants not only want to see a strong performance for the quarter in question, but also a nod towards that level of performance continuing or at least improving. And clearly Jet2 were unable to provide that, and facing a bit of a crosswind as a result.
Yeah, I think they also said, I'm trying to ignore that.
It didn't work, did it?
No, it didn't. They also said that people are booking later.
Yes.
Which suggests that people are less optimistic about their, sort of I don't know, fiscal situation. And as soon as it becomes clearer, they think, well, okay, let's go for a quick getaway.
Yeah,
as opposed
might
to booking
also
3 or 4 months in advance.
Yeah, it might also be a sign of people, again, that lack of confidence in the financial situation, people trying to take advantage of potential discounting. It generally works one way or another, where the closer, certainly in terms of package holidays, the closer you get to the booking date, they're knocking them out for sort of bargain basement prices in a lot of instances. But again, that's not necessarily a particularly brilliant sign, because people don't have that confidence to sit here now and book a winter break, for instance.
Yeah, because in the off chance they might get it cheaper nearer the date. So
yeah, exactly.
And I think that was symptomatic of EasyJet's first half numbers, which we talked about a few weeks ago. They were saying that a lot of people were leaving it to the last minute, and as a consequence of that, they were having to cut the prices to try and encourage people to make these bookings. So
and that's where you can end up with a situation, obviously, where booking numbers actually look relatively healthy, but things like revenue and margin start to get eroded, because obviously they're sort of knocking them out relatively cheap.
So I mean, we'll obviously look at EasyJet's numbers because they're due out next week. But before we get to that, we've got Dr. Martens, and they're trading in line with expectations. US is doing well. Trading in Europe, not so much. They've said it's more variable. They said their performance would be more H2 weighted, with the EMEA order book ahead of last year. So certainly, I think no change to guidance, still 45 to 55 million, which is up on last year. Things looking pretty good for Dr. Martens. Their shares are up 1%, holding on to the gains that we've seen since the beginning of March. So nothing to be overly concerned about there by the looks of it.
No, absolutely. I think a relatively solid report, and the market has reacted accordingly. I don't think there's any need for concern at all there.
So hopefully the worst is behind them, and they can start looking to maybe get back to the levels they were back in early 2024, when the shares were around about 100p. They're currently 77, so there's certainly potential
upside there, for
potential
sure.
further upside, most definitely. So just Levi Strauss was the final one, but they're reporting later tonight.
Close today, yes.
Yeah.
I'm sat here in a pair of Levi's, so
there you go. Not Dockers, are they?
No, they're Loke, actually, if you're interested. I don't think they're listed, but I will have contributed a little modicum to Levi's sales last quarter.
Well, that's jolly good. Okay, so let's move on to the week ahead. Obviously, bank earnings.
Quite a busy week.
It is, yeah. I mean, we've got big four US banks. We've got UK CPI. We've got UK wages and unemployment. US CPI.
Yep.
So obviously we've got second quarter China GDP. Not that those numbers really tell us an awful lot.
No, I forgot the pinch of salt that I needed to bring with me to
Yeah,
interpret those numbers.
industrial production and retail sales generally tend to be a decent indicator of the Chinese economy, but ultimately I don't think they're going to tell us an awful lot that we don't already know. I think what is interesting about China, though, Michael, is that they're in deflation.
Yes, they are. And although the latest CPI numbers did tick very marginally into positive territory, it's very much a case of one swallow doesn't make a summer. So they are still stuck in this deflationary spiral. And the efforts from the government in China, which is obviously a very, very differently run economy to here in the Western world.
Command economy.
Yeah, absolutely. They don't really seem to be having the desired stimulatory effect. So certainly one to keep an eye on there. But as I sort of jokingly alluded to, the usual caveats apply around any incoming Chinese economic data, certainly GDP. And maybe the best way to read it is if you get a downside surprise, which you may well do. Things could well be worse than that number implies, because that's the number they're happy to release. So how bad are things actually on the ground?
So in the first quarter, China retail sales averaged around about 4%. In the second quarter, there's been a significant improvement, averaged around about 5.8 if you basically go across April, May and June. Do you think that could well be reflected in the GDP numbers, which we saw growth of 5.4% in the first quarter, given the fact that the Chinese economy is now more balanced between manufacturing and consumption?
Yeah, potentially. I mean, that's obviously a transition or a rebalancing that the Chinese authorities have been trying to do for some time now. Of course, the obvious headwind that China is going to have faced in Q2 is this surge in exports in the first quarter as everyone tried to front run tariffs. That's not only going to have gone into reverse in Q2, but there was also an effective trade embargo between the US and China for sort of half of the quarter at the very least. So I think that may sort of counteract any positive impact that you might see from the improvement in consumer spending. So I think the trade figures are going to be worth watching closely as well.
Yeah. Okay. Well, it's certainly worth something to keep an eye out for next week.
Yes,
I think
that's early next week, isn't it?
15th of July I've got on my calendar. I mean, that could well be wrong, so you need to double check that. But it's the same day as I think the UK wages numbers, which for some inexplicable reason, are they on the 15th of July or are they later? I think they're on the 17th, aren't they?
I was going to say, I've got them on my Bloomberg calendar as Thursday the 17th, which I know we spoke about this earlier in the week, is highly unusual. The ONS usually release jobs data on the Tuesday, but in any case, we may as well move on to the UK, because I think let's start with the jobs data. I think that's just going to show more of the same and more of that glum, grim picture that the prior report printed, with unemployment continuing to move higher. We're basically at 4-year highs in terms of unemployment, just north of 4.5%, and payrolls continuing to decline. I put a chart out on my Twitter this morning.
Is that the same chart that I showed you?
It was, yeah. I went and made it myself. Payrolls have declined in every month since the budget last October, when, of course, Rachel Reeves announced the hike in employer national insurance contributions, and the decline in payroll employment in May was 109,000 jobs. Now, that's all pretty grim. But if you read the most recent PMI surveys and the commentary within those, certainly in the services sector, according to the respondents, the pace of job losses increased in June. So we could be in for an even grimmer number there. I guess the focus of the BOE, though, is going to be on the earnings components, which are still around 5%. They're saying they're too hot. I'm sort of sat here going, well, they're not going to be north of 5% for particularly long when this sort of a margin of slack is emerging in the labour market.
Yeah, I mean, the job losses have been accelerating from February. Every single month, they've got more and more. I mean, I'm looking at the stat here, and in February, we lost 28,000, March 35, April 55, May 109. So, that's not a good stat, and should worry the government. But, it probably won't.
Well, policy choices have consequences, ultimately. I think anyone could have told you, I think we certainly did at the time of the budget, this is going to be what happens. 6 months later, here we are. I'm not taking a victory lap. It was painfully obvious. And it's the last thing we want to see. But frankly, businesses have a choice. They either, stomach the increased costs, pass those increased costs on to the consumer, or lower headcount in order to keep the national insurance costs roughly the same. And a lot of businesses are going for that third option, which is having a really detrimental effect on not just the labour market, but UK PLC at large.
Yeah, since the budget, headline unemployment has gone from 4% to 4.6.
Yeah, and it's going to go higher.
Yeah, I think we'll see 5% by the end of the year at the very least.
Hmm.
I'm not going to put an offer in there. I'm 5 bid, so.
Yeah, but against that backdrop, of course, just to move on to the other main release next week, the inflation figures. Yeah, we're expecting 3.4, 3.3-ish% on the headline CPI next week. It's above the Bank of England's target. We all know that. But are we going to see an economy sustain that higher level of inflation with such a loose labour market? I really struggle to see. The Bank of England have become preoccupied, if not paranoid, about the risks of inflation persistence. That's fair enough, and I think they've had their fingers burnt by the COVID experience and don't want to make the same mistake twice, and I understand that. But this is a very different economy now, and it's an economy that is losing momentum at a real rate of knots. This paranoia over the potential for persistent price pressures just feels misplaced.
Yeah, I would probably agree with you on that. But as you said, once bitten, twice shy. And ultimately, I think there is a concern with the latest pay round coming along in the public sector.
Well, the junior doctors want to go on strike again, don't they?
Yeah. I'm not going down that rabbit hole.
No, we shouldn't.
But, for me, that is going to be a concern. And ultimately, I think that could well be one of the reasons why the Bank of England may be a little bit reticent in cutting rates too aggressively. So, yes, I think we'll see a move in August. I think that's pretty much nailed on. It's really a question of then what happens after that. We could see aggressive cuts if the economy starts to slow really rapidly, but that doesn't deal with the underlying issue.
No, absolutely. And of course, I think and we can discuss this nearer the time, we've still got sort of 3 or 4 weeks, but I think the key thing with the August MPC will be the language. Do they finally give up on this idea that further cuts are going to be gradual and careful? And if they change that line, then that opens the door to a much faster pace of easing as we move through the autumn. But that's one for the future.
Indeed. I mean, I know there was another stat that I saw this week. I don't know whether you saw City AM, but they posted something. Total employee numbers at UK lenders have fallen 5.25% to 530,731, according to data from the Banker magazine, the lowest number in a decade.
It's not good. I'll tell you what, if any of our listeners can find a positive UK economic stat that we can open the show with next week, then do let us know on Twitter or in the comments somewhere, because I think Mr. H and I are both struggling on that one at the minute.
But that's really worrisome. Financial services is such a big contributor to UK GDP.
It's a bedrock of GDP, yeah.
And ultimately, the UK financial institutions are cutting jobs at a rate of knots. And that is worrying. And, you've got to ask yourselves, why are they doing that? Because the costs of employing people have gone up sharply.
Yeah, well, and of course, it's not only the costs of employing people, it's also the risks around employing people as well with the whole employment rights bill. But again, that's a rabbit hole. Yeah, shall we move to safer ground?
Yeah, US CPI. Again, this basically ties into Trump and Powell and the Fed dynamic. I don't really think we're going to see any surprises there. ISM surveys still show that price pressures are elevated, even if headline inflation is around about 2.4, 2.3%, but core prices are higher. So again,
British, aren't they?
And I think that Powell knows he's going. So he's going to be in no mood to, I think, accommodate or respond. If anything, I think he'll dig his heels in.
Absolutely. I mean, if your mindset is effectively legacy management in the last 9 months while you're in the job, do you want to be remembered as the guy who, brought inflation back under, firstly provided stimulus during COVID, then brought inflation back under control after COVID, engineered a soft landing for the US economy? It's a hell of a legacy. It's a really, really good legacy. Do you want to be the guy who in the last 10 months, when I just became the president's yes man and ran the risk of inflation running riot again? Or do you want to be the guy who, when actually I preserved monetary policy independence of the Fed, ensured inflation remained at the target, inflation expectations remained anchored, and yeah, it meant I held rates for another 6 months until December of this year, but I did the job I was put there to do. I think
Exactly.
it's pretty obvious that Powell is going to be in the latter camp. So yeah, I certainly don't see anything sort of game changing from the CPI figures that we get next week. I mean, if it's soft, Trump's obviously going to have another rant, but he does that every day anyway.
Well, exactly. I don't think it's going to move the needle in any, particular, in any particular significant way.
No.
Okay, so let's move on to the earnings. Third quarter numbers from EasyJet. Now, we've talked about this before. The earnings outlook has always been a game of two halves for them. First half is usually pretty poor, but the second half generally tends to be an awful lot better. Now, obviously, increasing costs hampered the first half numbers, as well as what they called price stimulation, which to you and me is price cuts.
The most ridiculous bit of management speak ever, though,
Yeah,
isn't it?
yeah, it's a load of old nonsense, isn't it? So,
I'm glad you used that word.
yeah, I was being polite. So, forward bookings at the time for Q3 were 80% sold, so we're less worried about that. It's about Q4 now. Q4 was 42% sold, so I think we need to see solid gains here if we are to see EasyJet wipe out its first half loss. So it'll be interesting to see what the numbers are with respect to the rest of the year and whether or not they can surpass the profit numbers that they saw last year, because they had a pretty good year last year. But let's move on. Let's move on to Fraser's Group, who are reporting their full year numbers.
Yeah, and who own half the bloody high street these days.
Indeed, as well as Burberry's first quarter numbers, both reporting the same day. Interesting with Fraser's Group, because obviously I think Mike Ashley's got his hands full with all his various stakes in various businesses, his arguments with Boohoo, Revolution Beauty, he's pulled out of that. And obviously he said at the time that the budget was going to incur a 50 million hit on their numbers. Share price hasn't done particularly well. Do you think he's spinning too many plates?
Yeah, I mean, it does increasingly feel that way. You sort of look at Fraser's Group and you certainly look at Mike Ashley and you go, it's becoming a sort of jack of all trades, master of none situation. There's so many, not only is it so many things to focus on, it's so many different things in different parts of the high street to focus on, all of which trade in very different manners. And I do wonder whether perhaps that's one of the reasons why market participants are not exactly in favour of the share price at the moment, because it's almost a case of actually you need to rationalise things a little bit, trim down your operation, focus on doing a couple of things well rather than trying to do everything in a pretty average manner.
Yeah, I was looking at the H1 numbers, and there was an 8.3% decline in revenues, 2.5 billion. So it'd be interesting to see how they've done in the second half of the year, see whether or not they've made any of that up. But I certainly think that. Yeah, okay, Michael Murray is the CEO, but these distractions can't help, given that his attention is being split, because I think he's now on the board of Hugo Boss as well now.
He's spreading himself so thin, and I don't think anyone's ever done this before, but you could almost liken it to an Elon Musk situation where, you're involved with so many companies, you've got your fingers in so many pies that actually you're probably not, giving any of those companies the attention or the effort that they deserve.
Burberry. Let's move on to Burberry. Obviously,
your favourite brand, naturally.
Well, yeah, of course. I'm not a Burberry customer, never have been, never will be. But they've seen fairly decent rebound in their share price, despite the fact that their first year numbers were nothing short of a disaster, their full year numbers. Obviously, they outlined a plan to cut 20% of their staff, and I think that's behind, the current share price rebound. But certainly when you look at the numbers, same-store sales across all the regions were steep falls. Asia Pacific, 16% decline. America's a 9% decline. Obviously, the Burberry Forward plan by the new CEO is taking shape. Still early days, but I think the associated one-off costs appear to be in the rearview mirror. So the big question is, can the share price gains that we've seen thus far be sustained going forward, because we're now back above £12, just about. Can we continue to go higher and head back towards levels that we were trading at the beginning of 2023, end of 2023, beginning of 2024?
I mean, that's very much the question. I think we've moved past that point now of sort of peak pessimism when it comes to the stock. The market has reacted very positively to the turnaround plan. The Burberry forward, horrible name, but we have to use it. I think the question now is, has that turnaround plan continued to pay dividends? That's what markets are going to want to see in the numbers that we're getting next week. Is that still working as well as we thought it was, and as much as the market has discounted the good news? I think that's really going to be the focus as we move into that quarterly report. I mean, there's still a few question marks despite the increase in the share price and despite that turnaround plan over a potential takeover. There doesn't seem to be any sort of willing buyers at the moment. You'd imagine that the rebound in the stock has further put off anyone who may have been considering it. But, given the sort of general theme around consolidation in the luxury sector and acquisitions out of the London market, I don't think you can rule that out entirely.
No, I still think it's a takeover target. It has to be,
Yeah.
because 2023 it was £26, and it's still well below. It's more than half that. And that's well below its all-time peaks. So we've had a decent run from the lows in September last year at 557, but we're still only around about £12. So
So I don't think that chatter's going to be going away anytime soon. That's for sure.
No, indeed. All right, let's move on to US banks. US banks, they've seen some really decent gains this particular quarter after trading sideways for most of the first quarter. JP Morgan, Wells Fargo, Citigroup, second quarter numbers on the 15th, Goldman Sachs on the 16th. Now, I think one of the key takeaways that I took from the first quarter numbers was decent equity trading. Fairly decent gains there. M&A, not so much, but that does appear to be showing signs of picking up if recent activity in the M&A market is any guide. So I think for me, it's not about what they tell us over the course of the last quarter. It's how optimistic are they going forward.
Yeah, absolutely. I mean, I think the story of Q1 was we came into the year expecting a real boom in deal-making activity, and that did not happen in the first 3 months of the year. It was very, very subdued. And we saw those trading desks at all the big banks really carrying the slack, and taking over as the big revenue makers because of the incredible market volatility that we saw. Now, in the following 3 months, markets have remained just as volatile, certainly in the sort of first 6 weeks or so of the quarter, when we were reacting to all of the tariff headlines. So you would expect trading performance to have gone well once more. And as you say, the IPO market in the States has started to pick up. Mergers and acquisitions activity has begun to pick up in the States and across the globe. So I think you're looking at probably what could be quite a solid bank earnings season, which naturally would get Q2 earnings season as a whole underway on a pretty positive note. The only sort of two things I would say is, one, what provisions are made in terms of loan losses, given the degree of economic uncertainty that we see? What are the credit builds looking like? And the other point, of course, is that we have had a very strong run-up in bank stocks, certainly over the last 3 months or so. And actually, even year to date, Citi and Goldman trading up by 24-25% apiece now on the year. Have we priced in a lot of this good news already? And how high is the bar to actually deliver a sort of upside surprise and a positive market reaction on the back of those earnings numbers we're going to get at the start of next week?
I think that's key. I think you hit the nail on the head there. There's an awful lot of good news already priced in. The big question is whether or not investors see the potential for further share price gains based on that premium, which I think is already in there.
Yeah, absolutely. I think you're spot on there. We've come a long way, certainly from those April lows. Are earnings going to be good enough in order to push us on further? I think the final point I'd make on that is, if any of the banks are a little bit soft on their trading line or on their deal-making line, then I think the market is going to punish that very, very severely indeed.
One of the things I took away from Citigroup was there was decent growth in their wealth management division and private bank, which sort of contrasted a little bit from some of the other banks. So it'll be interesting to see whether Citigroup, which is playing catch up because it's well below its pre-financial crisis levels, whether there's potential there in the Citigroup share price to potentially punch even higher. Yes, it's done well so far, but still relative to where it was in 2008,
miles off.
It's miles off.
Yeah, and that's where, you know, we talk about the banks as a group, but there are significant differences. I mean, you know, someone like Bank of America, Wells Fargo, they've got much larger retail banking operations. As you've touched on, Citibank, they pretty much do everything, to be fair, these days. Morgan Stanley and Goldman Sachs have gone much more down the asset and wealth management route. So there are sort of various nuances between the big banks, and one of the reasons why they're so attracted to asset and wealth management is because it provides, or is perceived to provide, a much sort of steadier income stream than some of the more volatile areas of their business, such as deal making and trading, as we just mentioned. It's not going to be the showstopper that those two are, but it's just that steady bread and butter revenue that they want to be ringing in, and which investors are cheering.
Okay, so certainly worth keeping an eye on those, because I think it just sets us up for the flavour of the next few weeks when it comes to US market valuations, which brings me on to obviously our final look at next week, Netflix.
Yes.
Netflix, I mean, Netflix shares, they appear to be able to do no wrong.
They really do, don't they? It is quite remarkable how well Netflix have traded and how well they continue to trade. They have been on an absolute tear. And actually, I was going into we have come off a little bit over the last couple of weeks. We're sort of 4 or 5% off the all-time high that we saw at the back end of last month. But I was looking at some of the pedigree around their past earnings reports a little while earlier this morning. They've had 5 upside surprises in a row in terms of their quarterly earnings numbers. So, things are looking good by all accounts for the report that we get after the close on Thursday, this time next week.
Yep. So the headline numbers for Q1 came in ahead of forecast. Net income surged to $2.89 billion. That was well ahead of the $2.44 billion forecast. And there's a big leap in operating margin to 31.7%. Now for Q2, this is what we're expecting. Net income over $3 billion, with operating margin expected to rise to 33.3%. But even though they raised their net income, they kept their 2025 revenue target unchanged, 43.5 to 44.5. So that's where I'm going to be looking at. And also they kept their operating margin target unchanged at 29%. So that suggests to me they're expecting a slowdown in Q3 and Q4.
Yeah. Potentially a reflection of the uncertainty that was on the outlook, when they last reported in a similar manner to the airlines that we were discussing about much earlier in the podcast. Although the environment remains uncertain, we are now 3 months down the line. We're much more used to dealing with it and grappling with that uncertainty. So I think that is potentially cause for them to give a little bit of an upgrade there. The other thing that does seem to have gone very quiet is President Trump did at one point float the potential of tariffs on films that weren't made in Hollywood. We haven't heard any more on that, so I wonder whether that even gets a mention perhaps from an analyst in the call. But in terms of the stock can do no wrong, that might be the biggest bear case.
It could be, but I just can't. I just think there's hot air on the president's part, because ultimately I think when you're filming something on location, that's the whole point of it, right?
Oh, absolutely. I mean, the whole thing, we are still very long of noise and short of signal, but nonetheless, maybe one to bear in mind.
Absolutely. Okay, well, that's it for this week, ladies and gentlemen. Had a few technical problems on the call, so have to apologise for that.
Yes, apologies for that.
Hopefully it won't be too apparent, but we'll come back same time next week and have a look at the numbers and see whether or not we continue to make new record highs. But certainly I don't think there's any signal or any significant evidence that the markets aren't likely to continue to push to new highs.
Absolutely. Fully agree. Great to chat as always, mate. Look forward to doing it again next week.
Great stuff. All right. See you all again next week.